Commercial banking is next, and it's larger in scale than business banking. Clients using commercial banking products and services have more complex needs, and this includes having a more complex supply chain. The needs of commercial banking clients are focused around operating accounts and loan finance products, transaction banking, such as cash and treasury management products and services, trade finance, and foreign exchange. There will also be some advisory services provided in commercial banking, but as the client needs change and grow more complex, they will usually move into the next tier of banking services, which is corporate banking, covered in the next session. Let's spend some time to look at each of the products and services provided through commercial banking. Looking first to the operational needs of a mid-sized company, they are no different than the operational needs of a small business. They'll require an operating account to deposit payments from customers and to pay suppliers and their employees. They also often have a business savings account. They often will use this account to set aside funds to be used for future capital purchases or to cover any unanticipated shortfalls, much like business banking. And finally, some of them, such as large retailers, will need merchant services, the ability to accept debit and credit card payments at the point of sale or for e-commerce transactions, once again, like business banking and small companies. The fees charged tend to be largely the same for mid-sized companies as they are for smaller companies, although, because the volume of transactions tend to be greater, they are often offered a better discount than a small business would receive. Regarding loan finance products, again, the products are the same for both small businesses and mid-sized companies. Working capital will be managed through products like overdrafts and lines of credit. Commercial credit cards will also be used, but typically these are different from business credit cards in how they are used. For example, a small business may use their credit card for many of their purchases. However, a mid-sized company is more likely to use their credit cards for smaller purchases and for employee expenses, as it's easier to manage these purchases versus requiring each small dollar purchase to require purchase orders and a more rigorous purchasing process. The line of credit for a mid-sized company is also likely significantly higher than what a small business would use. For example, a business line of credit would be for up to $500,000, whereas a commercial line of credit would be more than the $500,000 and could be several million. The same holds true for the loan finance products for capital expenditures. Similar to business banking, commercial banking products include commercial mortgages, term loans, and equipment finance. Again, the difference is that the loan amounts in commercial banking are significantly higher than those found in business banking. Cash and treasury management can be thought of as three activities, all requiring different products that manage the working capital cycle: payments, which represent cash outflows; receipts, which represent cash inflows; and cash, which represents liquidity. Regarding payments, there are several products and services that a bank may offer its commercial banking clients for managing payments. Supplier payments, also known as straight-through processing, is a service where the client submits a listing of all its accounts payable to the bank. The listing will be made up from purchase orders processed when buying from suppliers. As invoices are received, the bank is notified, and the bank will then automatically pay the supplier on the client's behalf. This frees up the administration of payables for the client, allowing it to focus on more operational matters. The bank will charge a fee for every payment processed, with the fee at around a few cents per transaction and moving from there depending on volume. The higher the volume, the lower the fee. EFT payments were explained somewhat in the business banking session. To explain how they would work here, I'll use ACH payments for my example. ACH stands for Automated Clearinghouse, and it's a North American EFT system. ACH payments go from the originating bank to a central clearinghouse called the Automated Clearinghouse Network. The ACH network approves the transaction, and the money is then sent on to the receiving bank for posting to the supplier's bank account. Similar to supplier payments or straight-through processing, the fee will range from 5 to 10 cents per transaction, depending on the volume of ACH payments made. The difference with this type of product is that ACH payments are made as bulk transactions, meaning it may take more than a day for the payment to be received by the supplier. The bank usually processes these transfers in batches, and so it may wait until enough of them are received before reviewing and approving them. There are similar types of EFT systems globally, including those mentioned earlier, such as NEFT in India, as well as CHAPS in the UK. Wire transfers are another form of electronic payment available. They're similar to EFT payments, but differ in how they work as well as the costs associated with them. Unlike EFT payments, which cost cents per transaction, wire transfers cost significantly more, often costing anywhere from $10 to $30, or euros or pounds sterling as the case may be. They transfer funds immediately from one bank to another once funds are confirmed. Whereas EFTs go through an intermediary, wire transfers are direct bank-to-bank transactions. Wire transfers can be made for domestic transactions, but they are more often used for cross-border transactions, where the risk of payment default may increase. Wire transfers are usually done through a system like SWIFT, which stands for the Society for Worldwide Interbank Financial Telecommunication. A SWIFT banking code is provided, so the sending bank has a confirmed identifier for the receiving bank. Another wire transfer system is SEPA, or Single European Payment Area, in Europe, which easily facilitates cross-border transactions relevant to the EU. Moving to receipts, electronic funds transfer is a product that can be used to facilitate the shortening of the working capital funding gap. We've already discussed EFTs at length in the payments explanation, so I won't expand on it further here. Instead, let's look at the other options that companies can use to manage their receipts and shorten their cash cycle, or funding gap. Receivable lockboxes are located at the bank. The customer will mail their payments to a special post office box printed on the company's invoice. The bank collects the payments from the box throughout the day, and they're processed immediately, with the money deposited into the company's operating account. There's a similar electronic version as well, where the customer will electronically pay into an e-lockbox, and the bank will process the transaction against the relative invoice while depositing the money into the company's account. In both situations, this saves the company time and they receive their payments faster. The bank will charge a fixed setup and continuous monthly fee for each lockbox, as well as a transaction fee of around 10 to 20 cents for each receipt processed. With invoice discounting, the company will borrow a percentage against the value of their customer receivables while retaining ownership over them. However, they transfer the collection activities to the bank. The bank will manage the collection of receivables, freeing up the company to focus on other operational issues and leaving the collection to others who are experts in this field. So essentially, the company uses unpaid sales invoices as a collateral for borrowing. There are two fees charged for invoice discounting. First, the bank takes a percentage on each receivable collected, called the discount. Usually, this will be 2 to 3% and can be considered the cost of borrowing. In addition, the bank charges a monthly administration fee, which essentially covers the costs for it to provide the collection service. This fee is usually charged as a percentage of gross revenue, and the percentage will reduce as sales volume increases. Companies can expect to pay anywhere from 0.2 to 0.5% per month, depending on their sales revenues. Invoice factoring is similar but different. With factoring, the customer receivables are assigned to the bank, and the company will receive the value of those receivables less a finance fee, which is similar to the discount. In factoring, the company doesn't retain ownership of their receivables, but rather they sell them to the bank. There are various types of factoring arrangements that can be made depending on the level of risk of the receivables defaulting. For example, a company may arrange for recourse factoring, which means that they're responsible to pay the bank for any invoices that a customer defaults on. Non-recourse factoring means they no longer carry the default risk, but rather the bank does. In these arrangements, it's common for the monthly administration fee to be higher than in recourse factoring. And in general, the monthly administration fee is higher than that of an invoice discounting arrangement, as there's a greater amount of risk assumed by the bank and higher administrative costs associated with managing those receivables. Let's walk through an example to explore how a company can shorten its working capital funding gap. A supplier, in effect, finances its customers by offering extended credit terms. Suppliers are inefficient financiers, as they must borrow at a high cost from their relationship banks at their own credit spreads. The customer suffers because of these inefficiencies, as inefficient suppliers can lead to a more expensive supply chain. Using invoice factoring or discounting, the bank, as intermediary, pays the supplier immediately in return for a fee as previously discussed. This reduces the supplier's reliance on debt financing and can even allow the supplier to extend the buyer's payment terms. If the arrangement is set up as non-recourse, then the bank assumes the credit risk from the supplier. This leads to a more efficient supply chain that in turn reduces costs for everyone. The final piece of the working capital cycle is related to cash. A company will want to make any cash it does have as efficient as possible so that it's working for them to achieve operational and organizational goals. Products to help in this area have already been covered in the payments and receipts sections, especially as related to electronic funds transfers. However, what about the cash the business already has on hand? For larger companies, that is, those other than small businesses, there's a likelihood that the company will have multiple operating accounts wherever it has a physical location. The operating accounts may all be held domestically, or it's possible that if the company has international operations, there will be accounts held in those jurisdictions as well. Where there are multiple accounts, there will be multiple physical cash balances in each, some positive and some negative, and interest and bank charges applied against these accounts as well. By using cash concentration or notional pooling, the company can either physically or notionally sweep all of their accounts into one master account and net positive balances against negative ones. This has the effect of both reducing any potential interest expense on overdrawn accounts and perhaps even allow the company to gain interest income. Let's talk about the difference between these two types of pooling methods. Cash concentration, or physical cash pooling, requires that the balances of the identified accounts are physically moved, or swept, into one master account. The result is that any surplus liquidity is bundled and capital is internally financed to the maximum extent possible. This saves time and money in managing payments, but it also saves on external interest expense, since the company is, in essence, using internal financing. Cash concentration is most commonly used for domestic accounts, but can also be used for international accounts where the balances are all of the same currency. Notional pooling is different in that the operating accounts retain the physical cash. Instead, the accounts are virtually or notionally swept into a notional pooled account. This allows bank clients to bring together individual account balances on a purely notional basis to calculate and maximize interest income and minimize bank charges. Because there's no physical movement of funds, the company doesn't incur any foreign exchange charges. Notional pooling is more commonly used where international accounts operate in different currencies. The final area for cash and treasury management products that the bank will offer companies are those relative to investments. Investment products are used when the company has excess liquidity. The type of investment product will depend on the future cash needs of the company. For example, if the company wants to keep cash on hand to cover 6 weeks of operating costs, then it may look at investing in a short-term deposit product, like a 30-day Treasury bill or a money market product. If the company is saving for a future acquisition, then it may want to invest in a longer-term product, depending on when it needs the cash, perhaps more like a 6-month or a 2-year bond. The bank will be able to help the company by providing these products.